Hey guys, it's John. I've been investing for years and lost a ton of money along the way. That was until a few years ago when I actually decided to start listening to what I'd been reading and learning all along. I'm going to share with you the lessons that I've learned and that have completely transformed my results so that you can do the same. So let's get into it. Before we get started, if you want to know the best ways to grow your wealth, then make sure you subscribe to this channel. That way, you'll get notified whenever there's a new video. And if you enjoy this one, make sure you hit the like button to help spread the word. The first lesson I learned was what money I use to invest. So many people, including myself, just jump straight into trading looking for that quick win, convinced about beating the system, only to lose everything. Now everyone will have their own risk tolerance, but whatever you invest, make sure you've got savings behind you. It may be boring to have savings, and the chances are you'll earn little or no interest, but it's important you've got something behind you. No successful trader goes all in. They all have a pot of savings behind them that they can either use for emergencies or to move into their investments in the future. Without a savings pot, you'll just end up overexposed. The second lesson is when you actually start. Well, that's easy. It's right now. All the evidence shows that the amount of time you spend investing far outweighs whatever you invest in. That's because investing isn't just about the profit on what you start with, it's about the compound growth that you get the longer you go on. Compounding is earning a return on a return on a return. Here's an example of 3 people investing just $200 a month at different ages. The difference between getting started at 25 years old is massively different from the ages 35 and 45. The person aged 25 invests 96k in total and grows to over 500k, whereas the person investing at 45 puts a total of 48k into their portfolio, but it's only worth 100k. Just to make this obvious, person 1 puts in double person 3, but their pot is worth over 5 times as much. You don't have to invest a lot. Like I said, it's really important that you've got savings behind you, but you should prioritize getting started as soon as possible so that you can get the full benefit. Lesson 3 is to make sure that you're putting a regular amount of money into investment funds. You can put excess into individual stocks and shares, and I'll cover that next. But investment funds are going to be the next best thing to savings and should be the basis for any investment strategy. Investing in a fund is just like investing in the economy, which over time continues to grow. From 1927 to 2018, the US economy grew by an average of 10% every year. Now, if you break down the numbers year on year, some are much higher and some are negative. But since you're going to be investing for the long term, it doesn't make a difference. You'll often hear the phrase, past performance is not an indication of future performance. And when you look at an individual company, that couldn't be more true. Just look at companies like Blockbuster that experienced a great run for many years only to disappear. Whereas when you look at the whole of the US economy over the same period, yeah, there were blips, but ultimately there was tons of growth. Now, there are a lot of funds out there that track different things, but taking Warren Buffett's advice, my choice would be the Vanguard S&P 500 ETF. Investing in this fund is the same as investing in 500 companies at the same time. Low risk, constant returns. The best strategy is to put 70 to 90% of all your investment money into funds. If you're a beginner, then I definitely recommend in up to 90% and using the other 10% for other investments like individual companies. And that's lesson 4, investing your money into individual companies. Ultimately, for most people, investing in funds is all you should probably do, as no other type of investment is going to be as low risk. But in the real world, humans like to play with risk and reward. It's why a lot of gamblers go from casinos and scratch cards to trading stocks and shares, albeit badly. So if you're an impulsive person or like to gamble, investing 10 to 20% of your investment money into stocks and shares will help scratch that itch, whilst knowing that your savings and funds are giving you some security. Now, I'm not saying that you just go off, pick a few high-risk companies and hope for the best. No, you need to have a strategy that avoids becoming gambling. I should say at this point, I'm no financial advisor. This isn't advice. There are risks with everything, and so do your own research and do it properly. But here's what works for me. Firstly, I always use a 5-year plan. I'm not interested in what they'll do this month, next month, or even next year. I look at their performance over the last 5 years and consider if I think they're a good enough company to keep doing the same over the next 5 years. Yes, you can go into lots of other details, but I know I'm no expert. That's why I'm using funds as well. Secondly, I always pair my choices. I find the next best competitor and do an equal amount in each company. The reason I do this is because if one of them loses market share, there's a good chance they'll lose it to their next best competitor. Of course, new companies come along all the time and they could both lose market share, but I'm at least reducing my risk. And third, I never time the market. If they meet the above two criteria, I just go for it. Looking back at my trading history, there were just too many times I either didn't go in because their price was going down and I thought it would go further, or it just kept climbing. If you're day trading, which is trying to slice profits over the short term, then I guess that's something you need to try and do. However, it's never worked for me. But if you're following a solid long-term strategy with companies that you think will continue to do well over the next 5 years, then a short-term spike or dip in the price is not going to make a difference. Just to give you an example how I've used the above method, back in 2019 I looked at the history of Amazon over 5 years. From 2014 to 2019, they had strong performance and growth, and I thought they would continue for at least another 5 years, so I bought in at $1,808 per share. Now, not a lot of people realise that a big percentage of Amazon's profits are from data and infrastructure services that they sell to other businesses. It's called AWS. So I looked at the next big supplier of these services, and it was Google. So I checked on Google's 5-year performance, and it too showed great growth. So I bought Google at $1,136 per share. My thinking was that if Amazon loses market share on AWS, then there's a good chance it would go to Google. But there was also a good chance that they would both grow over the next 5 years. I could have analysed the short-term performance and decided whether I thought it might drop, and then waited to buy. But I didn't. I just got stuck straight in. As of today, Amazon is trading at about $3,000 a share, which is 65% up from when I bought them. And Google is trading at about $2,600 a share, which is 128% higher. It's worth also saying though, that both these shares have been higher, and it's just recently they've had a massive drop. Lots of people say, there's gonna be a crash, and you know what, there probably will be. But if you're investing for the long term, it doesn't really matter. The biggest mistake you can make is trying to time the market. These shares would have to have in price before I would make a loss. And even if this happened, I'm fully confident they'll recover, just like what happened in 2020. Lesson 5 is not listening to the hype of other people and doing your own research. Everyone nowadays seems to have a stock tip based on what they've heard from a friend or a forum, but rarely do they work out, and most of the time they're just around some pump and dump scheme. For those of you that don't know, there are groups of people out there that overhype stocks in order to increase the number of people buying them and thus increasing the share price, only for these groups to then go and sell and make a ton of profit. A lot of these groups hang out in forums or Telegram groups, but honestly, I would avoid them at all cost. From what I've seen, these groups are all about confirmation bias, where anyone with a different opinion is just kicked out. They exist to reinforce a common belief and really aren't constructive environments. The best thing you can do is to follow your own research strategy. Mine, which is looking at the previous 5 years, is a really simple one, but that's what works for me. Now you might want to go into more detail yourself, which is good if that works out for you. But in my experience, going too far into different stats and data brings an emotional element to the decision that just never worked out for me. So that's what I've learned and what's working for me. The main points are: use excess savings for investing. Stick most of what you invest into funds. Make sure you take a long-term approach. Never try and time the market, and listen to yourself and not others. I hope you've enjoyed this video. If you have, I'd really appreciate the like to help spread the word. If you want to see more, then make sure you hit the sub button. And if you have any questions or think that I've missed something, leave me a comment below. Cheers then.